What's up, everyone? I'm Don Harkins. This is the Don Harkins Real Estate Show. Today, we're going to look at mid-year migration trends and data that just came out showing where people are moving to and from and how that's going to affect home prices and the business of real estate in general. We're also going to take a look at the huge move in mortgage rates right now that was just impacted by the jobs report and see where rates are sitting today and how that impacts affordability. And then we're going to go over a big bill that was just signed into law, which will take effect in March 26, that's going to protect mortgage borrowers from getting spammed and preyed upon by online loan salesmen. And finally, we're going to look at a new court ruling that's going to empower landlords to be able to collect appropriate fees to rehab their properties and protect their properties from people who have pets that may be taking advantage of the ESA letter situation. So diving right in here, we're going to look at the U-Haul migration trends. This is an annual report, but they actually release some data mid-year, and they break it out by major metros. And they look at these major metros to see where are people coming from, trucks that are leaving here, where are they going to and checking back into. And it's just very raw data that gives, anybody who's curious about migration trends some real-time insight that's unbiased. There's no reason for them to skew this, whether you're a housing builder or whether you're, a coffee shop or whether you're a real estate agent. This data can be useful to you to kind of see mid-year where people are coming and going from in real time. And what we saw with regards to Florida's real estate market is we're ranked number 3 for inbound U-Haul moves, which down from number 1 in 22, but still not bad. Tampa's number 3 in the nation for net inbound moves, so still strong growth there. Orlando and Sarasota both in the top 25. And major inbound migration from New York, Illinois, and Pennsylvania. So primarily as a real estate broker, as someone who might be selling your home, or even as a loan officer that might be originating new mortgages for home buyers, these are the markets where you're going to find your customers that are coming in the next 3, 6, 9 months. So it's good to understand what those markets are like, what's happening there, what's driving people down. Markets that are picking up speed and seeing more movers than in years past are Ocala and Lakeland. So obviously the Villages, big 55 plus, huge equestrian community here. Lakeland, that bridge between Tampa and Orlando, huge manufacturing, distribution, warehouse going on there. So those are good kind of up and coming markets to maybe keep an eye on where you can still get good affordability if you're looking to purchase investment properties. Other takeaways. So what's bringing people here? High affordability and lifestyle, position rental properties in those growing outer markets, and keep message focused on primarily timing. These tend to be seasonal movers that we're seeing from those winter markets. And so we're likely, if we're already seeing them in the first half of the year, we're likely to see that pick up pace and finish the year stronger. If we look at just the market as a whole and what's going on here in the Central Florida area, we have 4.5 months of inventory, very balanced market, not a seller's market, not a buyer's market. 22% of all properties are currently pending. So if 100 for sale signs go in the yards, 22 of them have a pending rider hanging on them. Still strong percentage of list price at closing, 97.4% percentage of list price. It's only taken homes about 2 months to close. For nearly a decade pre-COVID, 66 days on market was the norm in Central Florida. So we're very much seeing a return to the norm. And then one thing that I always like to keep an eye on is the original list price to final sold price ratio. So sellers still consistently overpricing their homes by about 5.5%, leading to higher days on market, leading ultimately to a final sold price that's lower because you have to do more price reductions before you ultimately wind up at that 97.4% of your list price. So be sure not to make that mistake. You can see a big difference here. The active properties on average sitting at 553, while the pending properties were priced closer to 527, and the ones that closed at that 500 mark. Inventory is really spread pretty evenly. Even in the upper price ranges, we're not seeing huge spikes in inventory. The areas that are seeing the lowest amount of inventory are those kind of entry-level homes in the 400 range to 450. So, if you have a home in that price range and you're on the fence about selling, you've got less competition in there than you do at the lower end. These are going to be primarily condos in the 175 to 200. We know all about the challenges of condo selling. And then we don't get really any inventory relief until we get up above the 800,000 price point. And even peeking into the luxury price range a little bit, what we can see is there's a fair amount of inventory in the 575, 600 range, but still really not a lot in the 6 to 7, 7 to 8, and 8 to 9 range. And then once we get 900 plus, we start to see inventory grow a little bit closer to 6 months. So creeping into a little bit of a buyer's market as we get up there in the million range. Heading into mortgage news, job count and mortgage rates go cliff diving. So you can see Friday's job report was always going to be this week's main event, and the jobs report was weaker than expected. We were expecting to see 20 or 75,000 jobs created. We only saw 22,000 new jobs added. So much weaker, which means the likelihood of the Federal Reserve lowering the rate at this meeting increases. But furthermore, this is the December outlook on where they think the Fed funds rate may be in December. And you can see going into the meeting, thought it would probably be right somewhere around 3.675. After the meeting, down to 3.6. So everyone expecting additional cuts or bigger cuts. The reason we like to talk about these reports and the Fed funds rate is not because the Fed funds rate moves mortgages. It doesn't. But you can see here, by the time the Fed cuts, the bond market will have long since responded to all the data that made the case for the cut. And this is exactly what happened last year. So you can see the jobs report came out. The markets have already moved in reaction to it. So when the Fed cuts rates next week, the move you're going to see is not going to be based on the data that the Fed used to make their decision. It's going to be based on comments made by the chairman of the Federal Reserve in his speech and forecasting that they're going to do about where rates may be in the future. But the bonds that underlie mortgage rates saw a similar move to that 10-year Treasury yield. And you can see Freddie Mac, which is our favorite look at, or the most accurate look at where mortgage rates are. It trails, it's a weekly look, but there's a Mortgage News Daily Actual survey where people are putting in the rates that they're actually seeing in real time. And you can see how much lower this dove. And if you look, this is the same setup for last year. We were down, going into that Federal Reserve meeting in September, on September 16th. And then the Federal Reserve cut the federal funds rate. And these are mortgage rates you're looking at right here. Mortgage rates took off and spiked higher all the way up to 7.13% in January. And now we have the same setup again. So you hear buyers and you see people kind of saying, well, the Fed might cut interest rates. This is going to be good for housing. This could be good for mortgages. It could be bad for mortgages. It could send mortgage rates higher. So what we might be looking at right now is the same thing we were looking at this time last year, which is mortgage rates at the lowest levels they may be for the next 12 months, potentially. It's hard to forecast this, right? Stuff that goes into it, CPI numbers, jobs numbers. It's impossible to tell where the data is going to be coming in. But point being, we finally made progress all the way back, hard fought progress back down to interest rates, which are really well into the middle to low sixes for many borrowers. Further relief for home buyers. You probably have seen some comment or something in the news. Even I think Channel 9 News did something about the Hometown Heroes program. This is fantastic. This is a 0% interest loan. It doesn't have any payments. So 0 payments, 0% interest. You can get up to 5% of your loan amount. So if you're borrowing $500,000, you can get $25,000 towards your down payment and your closing costs if you work in a specific profession. And there's a list of these professions. I'm going to run through them really quickly. But if you think you might qualify, or if you think maybe that you work in one of these professions, reach out to me and let me know, and we can see for sure. But You can see here the Hometown Heroes program, eligible professions. You've got nursing, all kinds of different nurses, medical technicians. These are your EMTs, your paramedics. You've got medical therapists, all sorts of different therapists, mental health workers, psychologists, psychiatrists, doctors, physicians, pharmacists, and pharmacy techs, other healthcare workers in the dental arena, patient care assessment, patient transport. If you're an orderly or a phlebotomist, you work at Quest. School members, assistant principals, teachers, cafeteria workers, counselors, social workers, teachers' aides, the whole gamut of school staff members, first responders, EMTs, paramedics, firefighters, public safety workers, your corrections officers, juvenile probation officers, court employees, people that work in the courts, child care workers, any worker at a licensed child care facility, military, and veterans. So, again, this program is just fantastic. And just to show you how impactful it is, this is a home that we were selling over in East Orlando. And this is kind of like a traditional loan that someone in those professions might be looking at if they are shopping for a home. And this is pretty good deal. It's a fairly low down payment. So your loan amount only 356. So it's a 3.5% down loan, 30-year mortgage, low down payment. And your cash to close to get into that house for a traditional borrower is about $25,000. That's about the least you can pay with your closing costs, your down payment to get into a house. And the price range on this house is $365. So, $25,000 to buy a house that's $365,000. Not a bad deal. That's going to give you a payment of about $2,172 a month. When you add in your insurance and your taxes, you're looking at about $2,700 a month. With the Hometown Heroes program, and again, this is zero interest, zero payments. It just gets paid back whenever you sell the house, and without interest. You look at the Hometown Heroes program, you've got interest rates a little bit higher, your payment a little bit higher, $2,300 a month, but your cash to close is cut by more than 50%. You're only going to have to bring $11,000 to closing to buy a $365,000 house. Your all-in monthly payment only $2,800, $2,900. I mean, $150 more. So you get to bring more than 50% less to closing. It's only going to cost you an extra $150, $160 a month. Really making home ownership a lot more affordable. People don't have to wait as long. They don't have to save as much to get into a home today and stop paying rent and start building equity. So if you have any questions about this program, be sure to send us a message. Let me know so we can give you some more information and see if you qualify. Trump signs law banning trigger leads. So traditionally what happens is a mortgage borrower or home shopper reaches out and they put in a mortgage application, and part of that looks at your income, pay stubs, your employment, looks at the money that you've saved, and then look at credit report also. We got to look at a credit score. Your rate is based on your credit score to a degree. And what's been happening is the credit bureaus look at the reason the score is being pulled. And when they see that you're pulling it for a mortgage, they turn around and they sell it to LendingTree and Bankrate.com and even Wells Fargo or Bank of America. And these people that sit there all day long with no mortgages to do because nobody trusts them and they're not good at their job, they get a phone list, a calling list, and they start calling. And we've had people who we pull their credit for a mortgage and they get 100 phone calls in a single day from these predatory, low-skill loan officers who can't earn referral business and can't earn the trust of real estate agents, so they have to buy these phone lists. So the Mortgage Bankers Association has been lobbying to put an end to this harassment, and Trump just this week, actually maybe today, signed this bill into law. It goes into effect March 26, and it bars abusive credit offers without the consumer consent. You can see here the Homebuyer Privacy Protection Act establishes a nationwide ban on the abusive use of trigger leads beginning March 2026. So Bipartisan support. I don't know that that ever happens, but pretty much everybody agreed that if you're trying to get a mortgage and you find a trusted loan officer, you shouldn't be harassed and spammed by 100 phone calls from low skill, high fee lenders with no customers and nothing better to do. So happy to see that go into effect. Next thing we're going to touch on here is your ruling for landlords. And quick summary of this, I'm going to jump ahead in case you're short on time, but landlords not required to automatically waive pet fees for ESA tenants. So you've got your service animals, which are trained with a specific skill to assist someone who has a disability. And the American Disabilities Act regulates this and provides protection, as does the Fair Housing Act. And then you have emotional support animals. Emotional support animals may be trained in some cases, and oftentimes they don't have any training, but they have a letter from a physician that has prescribed this animal. So this has just been flat out abused by tenants for over a decade. And customers of ours, we've seen, get these letters just to be able to take their dog on an airplane or be able to rent in a community that has pet restrictions when there's really no disability, there's really no condition. But it was literally go online, put in your credit card number, pay 75 bucks and get a letter in the mail. So finally, we've seen a ruling. The U.S. Eastern District of Louisiana and Judge Sarah Vance held that a tenant with an ESA, emotional support animal, seeking to have her landlord waive a pet fee, a generally applicable animal fee, was required to prove that the waiver was both necessary for her to use and enjoy her home and reasonable. Meaning, if your emotional condition, if your prescription for your animal also puts you in a position where you can't afford to pay a pet fee, okay, that may receive some accommodation and you may be eligible to have the pet fee waived. But unless you can show that it was necessary for that fee to be waived as part of your condition, landlords no longer have to waive those pet fees. They can still charge those $350, $400 pet fees and collect some revenue, collect some deposit money, because these pets are going to scratch up doors. They're going to leave messes on the floor. You're going to have to do grout cleaning. You're going to have to replace carpet. They're going to dig up the yard. They're going to tear screens. And everybody says, well, my pet doesn't do that. Or what if your pet doesn't do that? Everybody's pet does that. Don't care who you are. Pets are destructive to homes, period. They add more wear and tear to homes, period. They add more risk and liability to a landlord, period. There's higher insurance costs. So this is a win for landlords and property owners to be able to get compensation from tenants and close a loophole that's been taken advantage of for, quite frankly, a very long time. So landlords must waive the ESA pet fees is not a binding law anymore. We've got a ruling on that. And alternatives like installment plans, people say, well, I had to get this letter for this condition, so I can't afford to pay it. Well, now landlords can offer installment plans, let people pay that over time, almost like pet rent. So good ruling there for landlords and property owners. And then heading back to the mortgage rate picture really quick, just how big of a move have we seen? So this is January 13th. And January 13th, you can see 7.16% mortgage rates. And today, sitting not 6.44, sitting at 6.29% today on the index for the 30-year fixed. So a broad move downward in rates, not only just since this May 19th date, but really going all the way back to January 13th. And this is real savings. This is a major material value to home buyers. And it can be difficult to visualize just how big of a savings it is. So what I've done is I've set up 4 loan scenarios here. And this is what things would have looked like if you bought the median priced home. So purchase price 498, 408, and this goes back to our data over here. We're just pulling in the median sold price. And if we look at that home, 10% down across the board, so you can see No change in price for these three situations. Loan amount, no change in loan amount. But what we can see is if you look at rates in January, you'd be looking at a payment of $3,032.68. And if you look at rates today, that's a payment of only $2,773.59. And not only is the savings a lot of money, obviously, but it's also a equivalent price decrease, basically. So if you assume, well, what if the rates hadn't dropped? What if these rates had stayed the same and I just wanted to have this same payment, but I wanted to have it at the rates where they were in January 13th? How much cheaper would the house have had to be in order to have that same payment? And you can see here, the house would have had to cost $455,827 at the rates we saw in January for you to have a payment like you get today. So it's the equivalent of an 8.5% reduction in price when we see the mortgage rates move as much as they have. Essentially, every single house on the market, we know that values have gone up about 2% this year, but the cost to buy that home has dropped by about 8.5% this year. So the net effect to home buyers is homes are 6.5% cheaper today than they were in January. But furthermore, if we look at that payment of $3,032 on that $498,000 house that we would have been making in January, and we say, well, what if I'm okay with that payment and I'm okay with that home price, but I'm going to buy it at today's interest rates of 6.29. Well, if you're still willing to make this payment and pay that price at today's interest rate, what you're actually going to do is you're going to save $225,000 in interest payments over 30 years, making the home not 8.5% cheaper or 6% cheaper, but 35% cheaper over the life of ownership. By taking the money that you would save every month, which I did the calculation, the payment savings is $259.09. So if you take that $259.09 and you buy your house today for that price and that rate, but every single month you make that $259.09 additional payment to your principal, you pay the loan off so much faster that you wind up saving more than $225,000 in interest. So the opportunity that home buyers have today is massively understated and misunderstood. And when we see interest rates potentially float higher, as we know the average interest rate is about 7.4% since 1971, we're looking at interest rates that are materially discounted. We're looking at homes that are 8.5% cheaper today than they were in January. We're looking at an opportunity for people to build wealth or save $200,000 in interest payments by buying a home today if they didn't buy in January. Point being, we just saw how the mortgage interest rate moves ahead of the Fed funds and ahead of the FOMC meetings. So what I hope you'll take away from this video is that if you've been stuck in your home for too long and it's too far away from work, or it's too small, or you're paying for more space than you need, or you just hate your neighbor, or maybe you're separated and you're a reluctant landlord and you're waiting for interest rates to improve, they've already improved dramatically. In fact, we could see another 2, 3, 4, 5 years or more go by before we see them at this level again. We're all hoping they continue to go lower. And if they do, that's fantastic. But I do know people who in September of last year were waiting for them to go lower. And 3 months later, we had a couple of hurricanes, we had an election, we had a slew of bad economic news. And here they are 12 months later, still waiting. And we're just now getting back to that level. So don't let that be you. If you have any questions at all about buying a home or selling a home, about financing, your mortgage options, or about leasing out your property, becoming a landlord or property management, please be sure to reach out. And also, I'd love for you to like and subscribe to this video, share it with someone else who might be interested, whether they're a real estate agent or a mortgage broker, property manager, or just an investor or someone interested in real estate. Always happy to answer questions and read the comments and reply to people who may have a different take on things. So thanks again. I'm Don Harkins, and have a great weekend.